Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Nilesh Shah, Group President and MD at Kotak Mahindra Asset Management Company, member of MFAC, Chairman at AMFI, and part-time member of the Economic Advisory Council to the Prime Minister. Welcome to the show, Nilesh. Always a pleasure to speak to you. And I think we're talking almost after a year. Last we spoke was nearly at the same time when the pandemic had started, and we just realized and understood as to how it was impacting, one and all. Nilesh, my first question coming to you right now is that the scale with regards to what the second wave has hit us has been worse. Cases have gone on increasing, and in certain parts of the country, the situation is really bad. What would your assessment be with regards to what we saw from March 2020 to now?
So one, if we see from an economic point of view, the lockdown, which was criticized by many, resulted into savings of livelihoods, resulted into saving of lives, but loss of livelihood. It created problems for migratory labor, but it also ended up ensuring that in the rural hinterland, COVID-19 didn't spread. Now, from June onwards, we became more COVID appropriate behavior courtesy the lockdowns and all the noise around it. And then even though cases were rising, that lockdown brought the time to set up our infrastructure. It also gave time for doctors to experiment and figure out right course of action. And though the economy suffered massively in June 20 quarter, July onwards, it started mending its way up. We reached peak of active cases in September 20. Thereafter, cases started reducing and economy started growing. Somewhere around March 21, we let our guards down for the second wave, which came with a lot of ferocity. There was one mutation of virus which caught us by surprise. Second, people also didn't follow COVID appropriate behavior. Third, we were reluctant to force national lockdown like first time because of the financial and economic cost it can impose. And finally, economy is now slowing down a little because of all the impacts of second wave. So clearly, this has impacted economic momentum for adverse, and we have to now control COVID-19 so that economy can again get back the momentum.
Right. So, Nilesh, very rightly put and a right description that you've given us so far. Now, yes, we've started to see a slowdown. Probably at least the impact could be seen in the first quarter of FY22. Now, with that, we've already been started to talk about the third wave, which could be hitting us. We don't know what the timelines could look like. We don't even know if the third wave will hit us or not. But if it does, how do you think it should be handled, taking into consideration the economy and the healthcare side of it?
So there are multiple ways in which we can be better prepared for third wave. One, obviously, is vaccination. If we can create vaccination like US, UK, Israel, then to a great extent, third wave will not be big. Second is ramping up of healthcare infrastructure. Now, we have gone through a very challenging time for availability of hospital beds, oxygen, medicines like remdesivir. But now we have started getting our act together, and those things are increasingly available. Remdesivir production has jumped from about 35 odd lakhs to 1.08 crore a month. Oxygen, medical oxygen production has jumped up by about 4 times. Oxygen concentrators and tanks are being imported. You could see Indian Air Force plane bringing them. The world has also supported, as India had supported the world with hydroxychloroquine tablets or vaccines. So ramping up of healthcare infrastructure will also help facilitate tackling third wave. The third is regional and rotational lockdown. Now, when this mutation of virus happened, and I'm not a medical expert, but I remember reading in newspapers that Amravati was one area where suddenly virus had started impacting people and the caseloads was rising. Now, unfortunately, we couldn't enforce lockdown in Amravati and ensure that that didn't spread to other parts of the country. Now, maybe we should be better prepared to handle that kind of calamity by enforcing regional and rotational lockdowns. Yes, it will inconvenience people in that place, but others will be safeguarded. Finally, vaccination, ramping up of healthcare infrastructure, and regional and rotational lockdown needs to be backed by COVID appropriate behavior. I mean, clearly in the month of March, across many parts of the country, large gatherings were happening, whether it was religious festivals, whether it was social gathering, whether it was personal functions like wedding, or whether it was political rallies. Now, all those kind of large gatherings did result into spread of this virus. So we have to follow COVID appropriate behavior. I think if as a country, we can have vaccination, we can have ramp up of medical infrastructure, we can have regional and rotational lockdowns early, and if we can expect COVID appropriate behavior from our citizens, we will be in a far better position to meet third wave if it comes.
Right. So, Nilesh, would you be of the opinion that a second round of nationwide lockdown is something that is needed? Because it seems that the center is not really convinced. You had, Honorable Finance Minister also who came out and said that we will not look at a complete nationwide lockdown because that's something which will impact the economy as well. So, what would your opinion be as an advisor?
So, I'm not a medical expert who can opine on whether there is a need for national lockdown or not. This is in the realm of medical professionals. All I'm saying is that if there is a way to avoid lockdown by regional and rotational lockdown and by COVID appropriate behavior by citizens, then we can avoid national lockdown. National lockdown should be our last option because it entails higher cost. And in my opinion, subject to medical professionals, it is possible to avoid national lockdown through COVID appropriate behavior, through vaccination, through ramp up of healthcare infrastructure, and through, so these are the three things: vaccination, healthcare infrastructure ramp up, regional rotational lockdown, and COVID appropriate behavior. This four will be able to solve to a great extent national lockdown.
Right. So, Nilesh, with all of this, this is broad-based with regards to where COVID goes, how one should be acting from here on. Another aspect that our markets are considering right now is the Q4 earnings, which are going on. Now, what do you make of Q4 earnings and how are you reading its impact? Because clearly, if you see markets, we are not really very far from record high levels that we saw in the month of February.
So we saw a rapid jump in corporate profitability from September quarter. September quarterly profit of NSE 500 companies was almost 1,80,000 crore, 6 times more than June quarterly profit of about 32,000 crore. Many people thought it was one-time phenomena because of cost cuts, but December quarter showed 2,10,000 crore profit. March quarter, the trend has continued. In my opinion, NSE 500 companies should declare profit of anywhere between 20,000 crore to 2,30,000 crore this quarter. But that is past. Till March, economic momentum was gaining strength. But second wave has hit us more hard in April. And clearly more regional lockdowns has been enforced in April. This is bound to impact profitability, and which is where most of the managements are giving uncertain outlook about the future. They say June quarter could be impacted because of this regional and rotational lockdown. I think that project profitability trajectory of corporate India will be linked with regional and rotational or national lockdowns, and lockdowns in turn will be linked with COVID-19 curve. If COVID-19 curve in rest of India starts coming down like Mumbai, we will have lesser impact on corporate profitability. If COVID-19 curve does not come down like Mumbai in rest of India, there will be adverse impact on corporate profitability. How much will be pure function of what is the length of COVID curve.
Right. So, Nilesh, we are talking of, yes, there will be an impact in terms of profitability. So if you have to look at FY22 as a year, taking all of the current situation into consideration, is there an anticipation that the government could come out with measures that could, say, support the MSMEs like the way they already started doing in the first wave? The help that they started providing to people below poverty line? Because if you talk about partial lockdowns and the slowdown in the economy, that's something, again, a similar kind of support will be needed. So is there any anticipation on that front?
So we have to wait and watch how things pan out. As I mentioned, April is the first month in which lockdown started hitting economic momentum. And clearly, poor people, MSME, are the most vulnerable and they will require support. Now, government has already announced extension of that 2 months free ration to about 80 crore people, which will cover bulk of the poor. There will be, I'm sure, enhanced allocation to Manrega if there is a need. More crucial question is support to MSME sector. Now, this is where last year we saw credit guarantee mechanism from Government of India, where up to 3 lakh crore financing to SME sector was guaranteed by government. About 50,000 crore was given for NBFC and about 25,000 crore was given for real estate sector. So we could see similar schemes coming into play going forward if situation so warrants. But today, hand on heart, I can say that there is a need for it, probably a bit early. We are right now passing through the COVID curve. Once that curve starts coming down, then only we can think about taking action to cover for the same.
Okay. And with all of this, in case an expenditure that needs to be met by the government to meet all of these needs to support the smaller businesses below the poverty line people, do you think there is a likelihood of the fiscal deficit undershooting the revised estimates of 9.5% of GDP in FY21 as well? And how do you think, will the government be able to achieve this number that they've laid out in the budget and the actions that we've seen by the global rating agencies?
So most rating agencies have already confirmed that despite second wave, they are unlikely to change India's rating. Anyway, we are at a much lower level than what probably we should get on a fundamental basis. On the rating side, if you see, our foreign exchange reserve is $588 billion. Our total foreign exchange debt, when I last looked at, was about $565 billion. Now, out of that $565 billion, about $135 odd billion belongs to NRI deposits. Now, we all know that most of this NRI deposit is actually like CASA balance of bank. Technically, they can be withdrawn in a day, but they continue to remain. Now, let's assume that out of $135 billion, $100 billion is permanently likely to stay. And when those NRIs become resident, they will convert these deposits into resident deposits. So it's not money is going to go back. Now, if I remove that, my total foreign exchange debt becomes $465 billion against FX reserves of $588 billion. Now, show me one company which will be rated at just above investment grade when they have cash on balance sheet, which is more than their debt. Now, only learned people from rating agencies can answer this conundrum, where India has $588 billion for $465 billion of liability. And still we are just above investment grade rating. I mean, clearly we don't deserve the rating which we have got. We deserve far higher rating. Ratings wouldn't materially change, hopefully. The real question is fiscal deficit. And undoubtedly, if government is going to spend money, that will expand expenditure. And if COVID-19 impacts economic activity, that's going to result into lower tax generation, and hence fiscal deficit could expand. And here we have to look at innovative ways of raising resources. Government sits on huge amount of reserves. The same can be leveraged. The same can be monetized. And we have already seen announcements in the budget about monetization of government assets, about strategic divestment of PSUs. So there are multiple ways in which one can raise resources to fund or to generate revenues so that fiscal deficit can be contained. One of my favorite suggestions to the government over the years is to create a gold amnesty scheme. In last 21 years, we have imported roughly about $373 billion of gold on a net basis. If we add gold smuggling and gold which gets worn by travelers returning back from other countries, this number could be easily $500 billion. The market value of this gold, which is held by Indians, wherein just last 20 years we have added $500 billion at cost, could be easily upwards of $2 trillion. Now, why don't we monetize this $2 trillion of savings lying in a piece of yellow metal for upgrading our economy, for refitting our economy? Even if you target 10% of gold, which is lying with households, that's $200 billion. A 25% flat tax on that is $50 billion. That's roughly 400,000 crore. So we have to think innovatively to raise our resources so that we can fund revenue generation and expenses without increasing fiscal deficit.
Right. So Nilesh, what do you think is stopping the government from taking a suggestion of something like a gold amnesty scheme?
I'm not the government, so I can't answer. But one, on amnesty scheme, there is apparently a Supreme Court ruling which says that you can't launch amnesty scheme. So structuring has to be done correctly. Second, people love gold. Indians love gold. Now, this should not be construed negatively. So there will be, I'm sure, reasons which are best known to people why they are not utilizing this route.
Right. And Nilesh, with all of this, another aspect that we've seen is that the RBI in the last 1 year has been really proactive in taking the kind of measures that they have to help the economy. The last monetary policy as well, they shifted to a state-based guidance. Rates will remain lower for longer. That's what they've come out and said. They've maintained their accommodative stance. Now, taking all of this into consideration, the forecast that we're seeing for FY22 is double-digit growth, little upwards of 10%. That's what the RBI has come out and said. Do you think we are close to achieving double-digit growth in FY22, or is it going to be a daunting task?
So one, FY22 double-digit growth will be on a lower base of FY21. And we will be at FY20 level in terms of absolute size of GDP. Now, can we get double-digit? Obviously, as COVID-19 spreads, that number will keep on reducing. I will still put my money that India can achieve double-digit GDP growth in FY22. However, it requires vaccination, it requires rapid rollout of healthcare infrastructure, it requires COVID-appropriate behavior by citizens, and it requires regional rotational lockdowns rather than national lockdown.
Okay. And with this, if you have to look at growth, another aspect, Nilesh, that we are looking at is how big a focus on inflation should be? Because clearly, do you think RBI will be able to ignore inflation whilst focusing on growth? The reason I ask you this question is currently commodity prices have gone up the roof. I mean, it's been a one-way direction. Now, in future, if we see rising of input costs, that will incidentally increase inflation as well. How will the RBI stay with its stance, or do you think that's going to require an immediate reaction from the RBI?
So, see, we can't create a situation where when inflation rate is high, we say inflation is high, hence RBI should not lower interest rates. And when inflation is low, we say inflation will become high, hence don't lower interest rates. We have to leave it to RBI to manage inflation, which is now their constitutional mandate. They have been given a target to manage inflation between 2 to 6% or average 4% plus or minus 2% range. And so far, they have been fairly successful at that. Now, your point is absolutely valid that commodity prices are rising. Steel, copper, aluminum, oil, they all have gone up. Now, can that push inflation in India? My limited point is that in India, consumer price inflation is dominated by food and fuel. Fortunately, our granaries are full. Monsoon is expected to be good. So hopefully, barring few natural calamities impacting tomato price or onion price or potato price, we will not see sustained agriculture inflation, food price inflation. That takes care of roughly 50% of our basket. On the oil side, oil prices are rising partly because of demand, but also partly because of restricted supply. OPEC has been working in perfect coordination with Russia to control supply, and that's where oil prices have remained high. My feeling is that OPEC also realizes that they can't allow oil prices to go above certain level. So hopefully oil price rise will not be like other commodities. Today we heard iron ore prices up 10%. Hopefully such kind of things will not happen in oil. That will take care of another 15-20% of India product basket. So roughly on a 65-70% of India's consumption basket, we will be reasonably immune. On 30%, we will pay a price just like any other country in the world. So hopefully, compared to other parts of the world, our inflation will remain relatively under control. But we'll have to leave it to RBI to navigate the inflation issue.
And with this, another step, Nilesh, with the RBI is with regards to the secondary market GSEC acquisition program. Now, they have committed to an upfront specific amount of open market purchases of government securities. And the sole objective has been an orderly evolution of the yield curve, whereas maintaining comfortable liquidity conditions. Now, do you think this is something which will help them maintain the yield curve? Because if you take into consideration the borrowing program for the first half of FY22, now with that, this front loading of borrowing probably could be marginally negative for yield curves in the near term.
So on the yield curve side, we are seeing a pendulum kind of movement. Rates are going up in fear of inflation, in fear of size of government's borrowing program. Then RBI pulls it down by doing open market operation, by doing operation twist or GSET. Now, we will continuously see this fight between market and RBI, where rates will move in a pendulum fashion, little bit up, little bit down. My feeling is that eventually rates will rise as growth picks up, as inflation fear picks up. But it will not rise in a unidirectional manner. It will get calibrated by RBI. And as I mentioned, 65-70% of our basket, courtesy food and fuel, should not suffer from high inflation like other commodities. That does give some room to RBI. And RBI should be able to manage rise of interest rates in a calibrated manner. I mean, RBI has done a fantastic job. When US interest rates have almost tripled, our interest rates have barely moved. And that's all thanks to RBI's careful interventions.
Okay. And then with this, How are you seeing the bond yields move in India as well as US? The reason why I ask you about US is to ascertain how the flow of money could be into emerging markets.
So if we see US, very recently, one press report showed that Janet Yellen is talking about raising interest rates to control overheating of economy. And next day, press report suggested that Janet Yellen is talking about not raising interest rates. It shows the conundrum faced by US. But my feeling is that if I have to take a 10, 15, 20-year view on Europe, US, UK, they'll all be heading into the Bank of Japan way. If you remember, Bank of Japan started pumping liquidity since 1990. There are umpteen number of reports which have said that Bank of Japan will withdraw liquidity. But till today, they are pumping liquidity. They cut down interest rates to near zero level. Umpteen number of reports have suggested over the last 30 years that Japanese interest rates will rise. They haven't risen so far. So central bankers providing liquidity and interest rate boost, the monetary stimulus to the economy, kind of is becoming permanent in nature. And that's also possible because on inflation side, there is productivity, there is efficiency, there is a huge supply which has been created. Overall, my feeling is that US Fed will, just like RBI, continue to intervene in market to ensure that rise of interest rates or shortage of liquidity does not derail growth. Like us, US House and Senate also will go for election in 2022 or 2023. And that midterm election also will force Fed to keep soft policy so that economic growth can be revived. So overall, yes, there will be a tussle like Indian markets in global markets. Interest rates will move in a pendulum fashion, but no one will allow interest rates to rise exponentially.
Right. So with this, how are you seeing the FI movement into India? Because the rally that we saw from 2020 March lows to now, clearly an FI driven rally. However, if you have to talk about FY22 so far, almost 18,000 crore worth of selling is what we've seen, whereas DIIs have been buyers worth 13,000 odd crores. What do you make of this? Do you think that the kind of spread that we are seeing in the second wave is something which is scaring the FIs, and that's the reason why they're moving the money out of the country, and this is something which could continue?
So when we talk about FPIs, it's not a homogeneous group. It's a heterogeneous group. You have momentum investors like hedge fund, you have long only fund managers, you have global emerging market funds, you have India dedicated funds, you have sovereign funds, you have ETFs and index funds, and so on and so forth. Within FPIs, there is retail investors, there is institutional investors. Now, are all of them going to think alike? Answer is no. There will be a segment of no-wise FPIs which will get influenced by what is coming in media. If they see funeral pyre, they will believe that the entire country is now worth selling, and they will redeem. And this is what we have seen in April also. But there is also a segment of FPIs which is experience, which goes beyond the headline. They know that in a country like India, these things happen, but eventually country overcomes that. When we had first wave, there were dire predictions that number of deaths will rise to millions, number of cases will go into crores. Now, fortunately for us, those predictions didn't become true at that point of time. So there will be a set of FPIs which will react based on pictures of funeral pyre. There will be a set of FPIs which will react based on longer term view. And in my opinion, people taking a long-term call on India will definitely overweigh people taking short-term call on India.
Right. So Nilesh, with this, do you think there is a possibility of another life high that we could see in 2021? Or do you think markets will remain range bound with bouts of correction? Because now if FIs on a cumulative basis, whichever segment they belong to are sellers, will the DIIs or the retail investors be able to take markets to these levels?
So Hiral, I don't manage money to make highs of the market. My job is not given to protect market. My job is to make money for my investors.
Correct.
Now, when in the month of March, April, May, FPIs were sellers, it was not my obligation to buy everything at 12,000 Nifty and ensure that there is no correction. If I could sense someone desperately selling, I'll keep on buying at lower and lower and lower levels. If he's desperate enough to sell at 7,500, be my guest. Why will I give him an exit at 12,000 Nifty? Similarly, on the way up, it's not my job to ensure that Nifty remains at all-time high. My job is to make money for my investors.
Correct.
So clearly, DII will do their job and markets will make a high provided Indian fundamentals support it. See, there are three things necessary for markets to move: sentiments, flows, and fundamentals. Now, flows can lift market temporarily or bring down market temporarily. We did saw that in the month of March 20, that markets corrected. But can it remain at 7,500 if fundamentals don't warrant? Answer is no.
No.
So, in my opinion, domestic investor flows will be positive in FY22. Mutual funds, insurance companies, and pension funds will continue to invest in India. On foreign portfolio investors, there will be occasional outflows, but over a period of time, over rest of FY 2022, we will see positive flows. Will it be as large as FY21? Probably not, but certainly it will not be negative. The third thing will be retail and HNI participation. My feeling is that that number also will be positive. Retail investors took a lot of direct equity from table for the quarter ending December 20 as well as March 21. But my feeling is that for rest of the FY22, they will be net buyers. So from a flow point of view, there will be money coming in. From a sentiment point of view, obviously, as long as COVID-19 is not controlled, it will be affected. But once we bring COVID-19 under control and economy resumes normalcy, sentiments will turn positive. Most important thing is fundamentals, because flows and sentiments can give you temporary movement. Long-term movement happens with fundamentals.
Correct.
Now we have seen September quarter, December quarter, and March 21 quarter. Last 3 months, corporate profitability is on the upswing. June 21, corporate profitability will get impacted because of COVID-19. But if September 21 again is like September 20, then we are back in business. The market highs will depend upon how we control COVID and what results we give in September 21 quarter.
So, well put up, in short, in terms of how everyone should read the markets currently. And from here on, Nilesh, the latest probably event that we had was the recent elections that were conducted. How do you think have the markets reacted to it? That's number one. And number two, any other front-loading events that people should be watching out for from an investment perspective?
So state elections do not materially impact markets. It's a good thing to talk about, but does corporate India's performance gets impacted because of election? The evidence based on past data is very, very small.
And with this, if you have to look ahead, which are the factors that could impact markets and create volatility? Because one aspect that everyone's talking about right now is how effective the vaccination drive will be, how the execution will be. Because if we fail on that end, do you think that's something which could have a direct correlation or impact on the markets?
So we have to appreciate that India today is one of the largest manufacturer of vaccine.
Correct.
In eradicating polio, we took about 30 years. In eradicating smallpox, we took about 7 years. So clearly, vaccination is possible, but there is some time needed. Now, today, we are probably one of the very few countries in the world who has developed local vaccine. AstraZeneca, let's give the credit to United Kingdom. But Covaxin is entirely India developed.
Correct.
Zycovid, Zydus Cadilla's vaccine will be entirely India developed. And Biological Evans is also putting their vaccine into phase 3 trial. So Russia, China, UK, US, and fifth country is India. And how many countries have developed 3 vaccines? We are on the way to develop 3 vaccines.
3 vaccines.
Now, vaccine manufacturing alone is not sufficient. You need to develop distribution. Now, Pfizer came out with a fantastic vaccine, but it requires cold storage, which most emerging markets won't have. We are developing vaccines which will be thermostable. That means they will remain stable at room temperatures or probably little 0-degree temperatures. Now that's an achievement. We had to face that constraint while developing vaccine. Then after vaccine comes syringes. And I'm again not a medical person, but when you are injecting COVID shield or Covaxin, it has to go into the muscle. That means your syringes has to be longer. Now you have to produce those syringes, otherwise people will end up using the same syringes and create bigger problems somewhere else. Now I was listening to Dr. Sharvil Patel talking on Zycovid. They're launching a vaccine which will get absorbed in the skin and it will require bigger syringes. So this will probably become a needle-less vaccine. Now that's a fantastic achievement because by doing that, you are ensuring that we can overcome limitation of syringes or a staff which can administer syringes. So there are lots of challenges which government is facing, which manufacturers are facing. It's manufacturing of vaccine, sourcing of raw materials, efficacy, absence of side effects, then it's the syringes, and then it's the distribution. So we are overcoming mountains of challenges to ensure that we can run against the time to provide vaccination. And I have no doubt in my mind that eventually we will reach there.
Right. I mean, with the process, yes, and everyone's become forthcoming to go ahead and take the vaccine as well from here on. And with markets, the way they are moving, Nilesh, what would your strategy and advice be with regards to allocation as of today?
So in our view, markets are fairly valued. If you look at on a trailing basis, markets are trading at about 44 times. But the moment you annualize December quarter or March quarter numbers, markets are trading at anywhere between 20 to 22 times. I believe it is based on hope that COVID-19 will get contained and there could be some downside over there. But by and large, on a PE ratio basis, we are somewhere around historical averages, little premium to historical averages. On a price to book basis, again, we are little premium to historical averages. On a market cap to GDP ratio, we are now at 96%. Historical average was 76%. So compared to 76, 96 looks higher. But globally, market cap to GDP ratio is 128%. Compared to 128, 96 looks lower. So overall, I will say we are at a slightly higher end of our fair valuation, maybe marginally fair value plus. But if we contain COVID-19 curve and the trend of corporate profitability continues to be as good as September-December quarter, then market has limited downside. At this point of time, we believe market is fairly valued. You should have neutral allocation to equity. If you are leveraged, it is time to cut leverage position. If you are underweight, it is time to buy some equity despite COVID-19. But if you are neutral weight, you just have to wait and watch, don't do anything. In case market gives correction because of lockdown, because of COVID-19 not coming under control, for any reason, then I believe that will be a good opportunity to become marginally overweight. Use correction as an opportunity to increase your allocation to equity.
Right. Absolutely. Increasing allocation on corrections is one of the best strategies that you're recommending. And then with this, what would the sectors that we should be looking at? Because clearly everyone's playing infrastructure right now. Another aspect that Nilesh we've spoken about earlier as well is that how home improvement companies could be outperformers in calendar year 2021, taking into consideration that last 1 year, no one's really done anything with regards to improvement in their homes, in probably say their offices, etc. So logically taking steps into consideration, which sectors would you allocate?
So one segment, one broad call which we can take is that in case COVID doesn't come under control, then defensives like IT, pharma, FMCG will do well. In case COVID comes under control, then cyclicals like cement, metals will do well. So that's a pure call on COVID. If it's coming under control, cyclicals, not otherwise defensives. But if we take a normalized view, assuming that COVID-19 will get under control thanks to vaccination and ramp up of healthcare infrastructure and regional lockdowns and COVID appropriate behavior, then sectors like home improvement continues to look promising. Within technology, there are some companies, including in mid-caps, which are doing excellent work. Private financial services, by virtue of their large weight in the index, also provides a good opportunity. Hiral, this will be more bottom-up story from here onwards, because clearly bulk of the market is trading at nearly year-high prices. One will have to be careful in picking up stocks. My recommendation will be avoid leverage stocks. They will get hit by the economy adversity in case lockdown gets extended. My recommendation will be to follow this concept of big becoming bigger. Clearly, lockdown and slowdown hits smaller companies far worse than bigger companies. Bigger companies will take advantage of this opportunity and grab market share from smaller companies. So big becoming bigger and avoiding leverage company will be two guidelines which will be necessary to build a portfolio in this market.
Right. And very lastly, Nilesh, with all of this, another investment asset class that's emerging right now, especially for the millennials, is the cryptocurrency. And I think for the longest, you've come out and said that the government probably needs to look at a gold coin, somewhere like a Bitcoin, which needs to be legalized. Do you think this is something which could emerge as a really legal asset class as well from here on, or what needs to be done according to you?
So my experience is what I will call as matka versus lottery. And it's a crude representation, so give me some freedom on creativity. We all know matkas used to operate in Mumbai and probably other parts of the world. It was illegal lottery. Now, what was it creating by keeping it below the ground? The reason you wanted to keep matka banned is because poor people should not lose money. But what was happening? The greed of becoming rich overnight was driving them to play matka.
Correct.
It was creating entire black economy where matka originators were, mostly criminals. Matka playing was below the radar. And we created an entire black economy around matka. Now move that into lottery. It became regulated. In a state like Kerala, 75% of non-tax revenue is coming from lottery. By regularizing lottery, you are ensuring that people behave responsibly, state gets fair share of revenue, and you are able to manage it in a white economy. The same thing is prohibition in Gujarat or Bihar. Now, the reason why you want to launch prohibition is that so that people don't become drunkard. In the process, what happens? You create a parallel economy where people who want to drink will drink either officially or unofficially, and the state will lose revenue. So we have to take a call away from moral obligations. That is matka good or is lottery good? Is prohibition good or is responsible drinking good? We obviously don't want poor people to lose money in lottery. We obviously don't want entire country to become drunkard. But how do we create responsible industry from criminal industry? And that same rule should apply to cryptos. By banning cryptos, what did we allow? We created a parallel market where you were investing in cryptos offshore through your offshore accounts. You were playing in a kind of satta bazaar. illegal dabba market, as we call. There was rumor about a big loss to investors in southern Gujarat in cryptocurrencies earlier. I don't know how much truth is in that, but there were rumors about it. So my opinion is always sunshine is the best disinfectant. Let everything be out in open. If someone is making mistake over there, we can always take corrective action. Let lottery, liquor industry, tobacco industry, cryptocurrencies, etc., become a responsible industry instead of becoming criminal industry.
Absolutely, very well put out. And I think today's in millennials as well, Nilesh, are the ones who are looking at a digital aspect with regards to investments as well. So this is something which could be forthcoming. Thank you so much for joining us on the show. Always a pleasure to have you. I hope you enjoyed the conversation with us as well. Thank you and stay safe.
Thank you. And I wish all your viewers remain safe. I pray for their good health. Please take appropriate behavior because of COVID and safeguard the nation.
Absolutely. I think we have to be, morally responsible for all of us and everyone around us as well. Thank you, Nilesh. Thank you so much.
Thank you.